Howdy, y'all. Welcome to Liberty Call for Monday, May 19th, 2025. Hope you're having a fantastical day out there in the interwebs. It's kind of gloomy here today. It was sunny this morning, but the clouds have come in and it's a little chilly outside. So not excellent. Anyways, all right. Well, markets are mixed today after Moody's downgraded the U.S. credit rating, citing ballooning debt and fiscal dysfunction. Who would have thought? They did this on Friday after all the news had closed. So we'll cover that article in a little bit. Yield spiked, gold climbed, and the dollar slipped as investors scrambled for cover. TXNM Energy and Novavax popped on bullish headlines, while Washington advanced both tax cuts and crypto regulation. Oh, and a major tornado outbreak is hammering the central U.S. So before we dig into all the news, I need some help from you. If you could do me a favor out there, give me some thumbs up, like, share, subscribe, follow, and press the notification bell. All righty, well, let's hop into the markets for today. Dow Jones up 0.32%, 137 points, closed at 42,791. S&P 500 up 0.09, 5 points, closed at 59.63. NASDAQ up 0.02, 4 points, closed at 19,215. The VIX was up 5.28% today. It's at 1815. Canada was closed. Let's see, Brazil up 0.39% and Mexico up 0.91. Going over to Europe, Germany up 0.58, the UK up 0.17, France down 0.04, Netherlands down 0.15, Spain up 0.25%, Italy down 1.2%, Switzerland up 0.06, and Portugal up 0.19. Let's see here. Russian exchanges both green today. The MOEX up 1.5, RTSI up 1.95, and the overnight markets, I see a ton of red. The Nikkei in Japan was down 0.68, Australia down 0.58%, New Zealand down 0.37, Shanghai flat at 0, the Shenzhen component down 0.08, China A50 down 0.42, TJ Shanghai also flat at 0, Hang Seng down 0.05, and the Taiwan weighted when it was last open on the 16th was up 0.52. All right, so those are the markets for today. Let's dive over to the weekly economic update and see what's going on there. Stocks roared higher last week, powered by upbeat trade news and tame inflation reports. The S&P 500 index rose 5.27%. The NASDAQ spiked 7.15%. The Dow industrial average added 3.41%, and the overseas markets increased by 0.8%. Stocks pushed higher on Monday as investors cheered weekend news that U.S. and China temporarily agreed to back off steep reciprocal tariffs. Then a mild inflation report for April, the slowest annualized consumer price index reading in 4 years, boosted markets on Tuesday. Tech stocks powered the rally as the S&P 500 closed trading in the green for the year. Markets closed the week with modest gains, largely looking past weak consumer sentiment data released on Friday. Friday was the Dow's turn to erase year-to-date losses and get back in the green, while the NASDAQ and S&P notched a 5-day winning streak. All right, so good stuff. All eyes are on economic data. The retail CPI and wholesale inflation reports, the producer price index, were mild, although most economists didn't expect tariffs to impact prices in the first month of implementation. Retail sales ticked up slightly as expected, while industrial production and housing starts showed signs of tariff impact. Expect traders to continue to closely watch economic reports to better understand whether tariffs are showing up in the data. Economic data coming out this week. Monday today, we have New York Fed President John Williams, Dallas Fed President Lori Logan, and Atlanta Fed President Raphael Bostic speaking. And we also have the leading economic indicators and e-commerce retail sales. Tuesday, Richmond Fed President Thomas Barkin, Raphael Bostic, and Fed Governor Adriana Kugler are speaking at the Financial Markets Conference. Wednesday, Thomas Barkin speaks in the 20-year Treasury bond auction. Thursday, existing home sales, jobless claims weekly, PMI composite, services and manufacturing, and John Williams speaks, plus the Fed balance sheet. Friday is new home sales, Kansas City Fed President Jeff Schmidt, and Fed Governor Lisa Cook are speaking. Got a handful of companies reporting earnings this week. Tuesday is the Home Depot and Palo Alto Networks. Wednesday, TJX and Lowe's. Thursday is Intuit, Analog Devices, the Toronto Dominion Bank, and Workday. All right, so that's the weekly update. hop into our market recap and see what happened today. SP 500 cut losses on dip buying following Moody's downgrade. The SP 500 trimmed early losses Monday as investors bought the dip despite mounting concerns triggered by Moody's downgrade of the U.S. sovereign credit rating. The agency cut its longstanding AAA rating to AA1, citing ballooning debt levels and a fiscal strain exacerbated by President Trump's sweeping tax cut agenda, which is estimated to add 3 to 5 trillion to the national debt over the next decade. Okay. I mean, we're going up by 3 trillion a year anyways, just on interest. So I'm not sure why that's going to matter. Treasury yields jumped following the downgrade, though Treasury Secretary Scott Bessent dismissed the move as a lagging indicator. Trump's tax proposal passed a key hurdle in the House over the weekend, positioning it for a vote this week, despite pushback from some Republicans. The downgrade has intensified scrutiny on U.S. fiscal health, with Moody's joining other major agencies in lowering the rating for the first time since 1919. In corporate news, Trump criticized Walmart for planning to raise prices due to increased tariffs, urging the retail giant to eat the tariffs, in quotes. Walmart, which last week warned it would not absorb all the costs of tariffs, if even the reduced tariffs from the recent U.S.-China trade truce, saw its stock fall by 1.5%. Elsewhere, NVIDIA CEO Jensen Huang unveiled a new AI data center and consumer-focused products during his Computex keynote in Taiwan, spotlighting the chipmaker's continued innovation. Reddit dropped 4% after a Wells Fargo downgrade, citing competition from Google's AI-based search offerings. Meanwhile, United Health jumped 7% after new CEO Stephen Hemsley and other insiders purchased shares, signaling confidence. Federal Reserve officials continued warning of policy uncertainty, with Minneapolis Fed President Neil Kashkari specifically calling out Trump's trade agenda as a significant drag on investor confidence. Despite macro headwinds, strong corporate moves and dip buying enthusiasm helped buoy the market as it enters a week of key policy and earnings developments. Well, Mr. Kashkari, what I would say is we've had several decades of irresponsible government and, just the way they've run the economy. So, I don't think the things that Trump's doing today are exactly going to do anything worse than where we're already at. So, I mean, these people truly cared. They'd cut spending. They'd get rid of every federal agency that was not outlined in the Constitution and, go on a serious austerity measures until we paid every penny of the debt back. But I don't see anyone doing that, quite honestly. All right, next up, that article I talked about from Friday. With Moody's downgrade, U.S. loses treasured AAA credit rating. And this came out, as I said, Friday, about 6:41 p.m. is the posting date on here. Moody's downgraded the U.S. credit rating from AAA to AA1 on Friday, citing persistent rising debt, surging interest costs, and ongoing political gridlock in addressing fiscal imbalances. This marks the first time in history that all major credit agencies, Moody's, S&P, and Fitch, have rated U.S. below AAA. Moody's emphasized that U.S. debt now exceeds $36 trillion and warned of a worsening trajectory due to proposed tax cuts under President Trump's administration. The downgrade came just as Trump's tax bill was blocked in committee by fiscal hawks, highlighting intra-party divisions. Moody's moved the outlook to stable, suggesting no further downgrades unless conditions deteriorate. The decision drew swift criticism from both political camps. Senate Majority Leader Chuck Schumer called it a wake-up call, slamming the GOP's tax agenda. Trump allies, including former advisor Stephen Moore, dismissed the downgrade as politically motivated. Again, the mudslinging between these two groups is hysterical. I mean, the federal debt, at the turn of the century was $4 or $5 trillion at the time, and now it's 36. So, you got Bush, Obama, Trump, and Biden. You got 4 presidents who have pretty much ran up about $30 trillion over the last 20 plus years. So I don't really think Trump's tax, agenda is really going to be the be all end all of things. Where are we? Market reaction was subdued. Bond yields rose modestly, and some strategists like Tally Lager viewed the move as a contrarian buying signal. Still, others warned of long-term consequences. Economists and market strategists, including Daryl Duffy and James Humphreys, warned that continued fiscal excess without reform will ultimately pressure borrowing costs and investor confidence. Despite the downgrade's largely symbolic impact for now, it reinforces concern over America's deteriorating financial health or fiscal health. Well, duh. All right, got another article here. It is exciting as you can't get out. So it comes from Zero Hedge, Why Keynesians Got Inflation and Growth Wrong, written by Daniel LaCale. So let's see what Daniel had to say. All right. Mr. LaCale argues that fears of runaway inflation and economic collapse due to recent U.S. tariffs have proven unfounded. Contrary to predictions, inflation remains subdued and economic growth steady. April CPI report rose just 0.2% with annual inflation at 2.3, a four-year low, while core CPI rose only 2.8%. Retail sales increased 0.1% in April and are up 5.2% year over year. Despite a 0.3% GDP dip in Q1, the private sector grew 1.6% annually, and Q2 projections show 2.4% growth. LaCale attributes the overblown panic to analysts who misunderstood supply chains and exporter dynamics. Exporters, especially China, face overcapacity and working capital challenges, limiting their ability to pass tariffs to U.S. consumers. As a result, costs are absorbed throughout the supply chain, preventing inflationary surges. He emphasizes that inflation is driven by excessive government spending and money supply growth, not tariffs. Encouragingly, deficit spending fell 35% from February to April 2025. LaCale views tariffs not as protectionist tools, but as leverage for better trade deals. He believes the U.S. economy is stronger than many assume, while importers holding more negotiating power due to their market size. With more trade agreements likely ahead, LaCale concludes the tariff tantrum was overhyped and Keynesian alarmism has again fallen flat. Well, Keynesians pretty much don't get anything wrong or right. So, I mean, it's, they're kind of like the Washington Generals playing the Globetrotters. All right, one last article here for the day. It's the Monday Morning Outlook from Mr. Brian Westbury at First Trust. This week's article, kind of in line with the last one. Does anyone care that Keynesianism doesn't work? Over the past 2 decades, Keynesian economics has dominated U.S. fiscal and monetary policy, culminating in what some economists now call peak Keynesianism. That's in quotes. Despite the earlier success of free market models advocated by Milton Friedman and Art Laffer during the 80s and 90s, when tax cuts, reduced regulation, and restrained spending drove strong growth. Keynesian policies have steadily expanded government influence over the economy. Since 2000, non-defense government spending has risen from under 15% to over 20% of GDP. And the M2 money supply has tripled since 2007 due to aggressive quantitative easing. If I could stop here, going back to the previous article where he was talking about how tariffs aren't necessarily inflationary. And I wholeheartedly agree, because in the scenario where tariffs increase costs on imported goods, the buyer, we the consumer here on the other end, we only have so much money. It's a zero-sum game. So if the cost of, I don't know, let's assume it's widgets, and they go from $100 to before the this whole tariff truce, say they go from $100 to $200, and you have to have this every month. Well, you're going to probably spend the $200, but cut your spending somewhere else. So that's going to cause deflationary pressure on other parts of the economy. So as opposed to everything going up when you increase the money supply, because you have too many dollars chasing the same amount or too few goods, which pushes prices up on everything all across the board. So for those people who if you want to sound smart at a cocktail party, and they say, well, these tariffs are going to be inflationary. You say, well, I don't think so, because if the cost of one thing goes up, and you definitely are going to buy it, you're going to spend less somewhere else, which is going to be deflationary elsewhere in the economy. So it will balance out over time. The expansion stems from 2 Keynesian beliefs: that government spending stimulates growth via multipliers, that has never come true, and that consumption, not savings or production, drives the economy. Politicians also favor these policies as they offer the illusion of prosperity without the pain of fiscal restraint. However, the results have been underwhelming. Real GDP has only grown at 2% annually over the past 20 years, half the pace of the post World War II era. Despite enormous advances in technology and massive government intervention, government spending surged from $3 trillion in 2007 to $7 trillion today. Yet savings have plummeted, trade deficits have widened, and economic inequality has increased. The data suggests that taxing savers to fund consumption weakens long-term growth. While real goods consumption rose 62% since 2008, value-added manufacturing grew just 14%, highlighting the imbalance between consumption and production. The author concludes that Keynesianism has failed to deliver on its promises. True economic revitalization will require cutting the size of government, reducing deficits, and embracing market-driven policies. And I would say instead of reducing deficits, it's actually paying down the debt that we owe. Where are we? Yet bipartisan resistance to reform makes the path politically difficult, even as the evidence mounts that doing more of the same will only deepen America's fiscal and economic stagnation. Why would anyone in Washington do anything about it? Because if you do something about it, you're probably going to, catch the ire of the voter who, unfortunately, you got your government employees who are welfare recipients. You got your welfare recipients who are welfare recipients. You got your government contractors or, people who sell to the government, so you got all these, people who are, tax taker or, they're takers from the government as opposed to givers like, taxpayers like you and me. So, eventually, people like me will run out and they'll, go bust. So, I hope the government completely collapses because I just don't see any of these yahoos actually doing anything to fix the problem. So, all right. Well, that's everything that I had to cover for today. Wasn't it great? I think so. If anyone needs to reach me about anything such as financial planning or investing or any of those good things, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'd be happy to help. All right. Well, that was a lot of news to cover today. As you can see, I put my dogs to sleep and the sun has come out. So we're going to go outside and do some ball time for a little while. And then what you want to do with the rest of the day? Probably watch some Astros baseball. Yeah, who knows? Anyways, hope everyone out there has a wonderful evening and I'll talk to everyone again next time. Adios.